Good morning. Today I want to talk about some specific considerations relating to the buying and selling of IFA businesses. Some of what I will talk about is generic to all similar types of acquisition and disposal of a business, but some issues are very specific to the industry and to the regulation that surrounds it. Firstly, who are we? We're Myerson Solicitors. We're based in Altrincham in South Manchester, and we have around 150 staff currently. Those staff sit across various legal disciplines, and they comprise corporate solicitors, commercial lawyers, property, real estate lawyers, including property litigation, wills, trusts and probate, and general litigation, to name the main business lines. We also have other departments which deal with family matters, probate litigation, and other legal issues. Generally speaking, we act for business owners and their businesses, and we cover all the critical issues that they encounter on a strategic and day-to-day basis. The financial services sector group within our business sits across all of our business lines and is headed up by me. I'm Chris Moss, and I'm a corporate partner by background. I've been doing the job as a corporate partner since 1994 and have a large range of experience across all forms of corporate activity and all varieties of business transaction, not least within this sector. I've also put on the slide details of myself with Olivia Sturgis, who works closely with me on financial services matters. Olivia previously worked for KPMG in London in the financial services team. We generally look at applications for permission, variations of permission. We can do supervision issues and any form of corporate activity, including mergers and acquisitions. The sector group as a whole has 12 sector specialists spread across all of our service lines. Personally, for many years I've acted for Dave Fishwick, not least on his Bank of Dave project, and that's encompassed getting a full banking license. We additionally act for various IFA and brokerage practices and have assisted in the formation of some new platform businesses. We can review regulated and unregulated activities and advise on the perimeter and on the agreements that businesses within the sector enter into. This includes appointed representatives, introduction type agreements, consultancy, custody, and trading agreements, together with customer terms. It's important, I think, initially to look at some background matters. Firstly, businesses within the sector are usually required to be authorised and regulated by the Financial Conduct Authority, the FCA. The regulatory overlay creates additional issues to be considered when undertaking any form of mergers and acquisitions activity in the sector. However, the first thing to really consider when you're looking at buying or selling is the legal structure and legal form of the business in question. Is it an LLP, an old-fashioned partnership under the 1890 Act, a sole trader where the owner and principal of the business has complete liability for everything that happens within it, or is it a limited company? If it's a limited company, is it limited by shares or guarantee, or is it another form of body corporate? And indeed, few people know, but some other forms of company do actually exist. The reason why this question is important is because it will determine much of the risk that is either assumed by the buyer or retained by the seller in any sale or purchase transaction. If the entity has limited liability, such as an LLP or a limited company, then particular views may be taken in relation to what liabilities are assumed by the buyer and what remains with the seller. One thing which does need to be considered is the nature of the permissions that both buyer and seller have, and whether, on the acquisition, those will remain adequate for the enlarged business going forward. Equally, from a selling angle, will permissions need to be continued beyond completion of the sale, or is there a cost saving to be had by deauthorising? Most forms of corporate activity and corporate sale, particularly if the entirety of a company is being sold, will require change of control consent from the FCA. This creates certain structural matters which need to be dealt with in the sale documentation and gives rise to some uncertainty as to whether or not the transaction can proceed, given the need for approval of the regulator. Whether there are any particular impediments to obtaining that approval really need to be looked at the outset. One of the critical factors for both parties is also going to be what is being bought or sold. If assets are being bought or sold, then those issues become more of a consideration for the buyer only in terms of understanding the liabilities that are associated with those assets, and in particular with any prior advice that may have been given in connection with them, and then the succession issues in relation to the contracts. Conversely, if shares are being bought, then acquisition of a company as a whole means that the buyer buys that company, and within that company, everything that there is within that company. This is often referred to as a warts and all acquisition. It's therefore very important to undertake due diligence to understand the liability position of the target company. For example, has the target company given certain advice, particularly in relation to transfers of final salary pensions, which could come back to bite the buyer, or which could be a liability which is not yet crystallised within the company? Generally speaking, acquisitions of interests in regulated businesses need to be notified to the FCA up to 10%, and acquisitions of controlling interests, 20% or above, beyond that level, will require the FCA's permission. I put on the slide something to just bear in mind because we've recently seen instances where regulated businesses have either issued new shares or done share buybacks, which have resulted in changes to the controller percentages, which should have been notified to the FCA and cleared with the FCA, but which have not been. This can create supervision issues down the line, which are in fact avoidable, and we can help mitigate any issues that may already have arisen. One of the features of the requirement for change of control consent, where it applies, is that it almost automatically gives rise to a gap between the exchange of contracts and completion of the transaction. Usually, on a transaction of this type, the parties will agree the deal, sign the contract, and complete immediately. However, where change of control consent is required, completion is conditional upon the FCA's stamp of approval, and therefore there is a gap between signing contracts and completion. Gaps between exchange and completion are very undesirable from a legal perspective because they give rise to uncertainty. This is because once contracts are signed and exchanged, the seller is bound to sell and the buyer is bound to buy. As a consequence, there's usually a discussion around what protections the buyer has during this gap period. Equally, the seller needs the flexibility to be able to continue the business as usual, and quite often, therefore, there will be a discussion of matters about which the seller can or cannot do in the gap period. Very often the buyer's consent is required for certain material issues, and very often also other issues may need to be notified to the buyer so they can give input if things are likely to become an issue for the business when the buyer takes it over. There are also some specific and significant structural considerations from a legal perspective in relation to this gap period. These include whether or not any warranties that are given by the seller are given both at exchange and completion, or indeed are repeated at points within the gap. And if they are repeated, then does the seller have the ability to disclose additional matters which come to light during the gap? If so, should that be limited to things which have just happened in that time period only? And what if something very significant happens in the gap? Should one or other of the parties, or indeed both of them, have the right to pull out of the transaction? If so, what are the consequences, particularly in terms of the costs that the parties have incurred? Who bears the risk? I mentioned before business as usual type provisions during this gap period. Sometimes it's difficult, other than in generalities, to really define what that is. If you can't define it, then it's difficult to see whether one party has in fact breached the agreement or not. All this, as I'm sure you can appreciate, gives rise to some fairly extensive negotiation around these provisions. And hopefully you can see that there is a lot of complexity, even in what is, on the face of it, a fairly simple set of facts and situations. One thing that's very important for both parties is to define precisely what is being bought and sold. Usually, and more often than not, these transactions take place as business sales, so that's assets. This is usually from a buying perspective, buying the assets of the target business. You would want as a buyer often, and the key asset, to acquire the book of business of the seller. This, however, comes with certain questions. What exactly is in there? What exactly is it that you're buying? Presumably what you want it for is the revenue stream, and that's going to be comprised of customer contracts. If you're buying customer contracts, then what other contracts do you need in place or to put into place to service that book of business? Usually as well, businesses are served by employees. Here, TUPE comes into play on an asset transaction. This is the Transfer of Undertakings Protection of Employment regulations. And these regulations basically provide that any employees who are working in the business, their contracts of employment transfer to the buyer automatically on completion by a form of statutory novation. What's worse is you can't contract out of TUPE. So this usually leads to a negotiation of price adjustments, often in the form of indemnities, in relation to which employees are coming to the buyer and what the buyer is actually taking on. You also need to consider the debts of the business and who is going to collect them. So these are the book debts of the business which are owed up to completion. And the key thing is whether there should be restrictions around the buyer effectively being able to sue the customer base or the seller being able to sue the customer base, depending upon who's collecting the debts out. Quite often, the seller will want to retain the ability to collect the debts out, and the buyer will want to restrict the seller from going after the customers that the buyer has just in effect bought. Finally, on this slide, there's the question of clawback in relation to business already written, and whether and to what extent the price is adjusted, and that is reduced, to take account of any clawback, and if so, over what period. Very often, business sales in this sector are structured on an earn-out basis, where net revenue is payable to the seller over a period of 3 or so years, and that net adjustment is taking account of clawback issues. Where the business operates using a platform, there will be additional considerations relating to the platform provider and how the customers are to be onboarded by the buying entity. As those of you who are familiar with the Consumer Duty will understand, the FCA's main mission relates to customer protection, and thus the customer journey to transition from old to new ownership is very important. Documenting this process and having a clear plan of how the customer transition is to work is of great benefit to both seller and buyer. From a seller's perspective, there are fewer problems with earning that net revenue, and from a buyer's perspective, you capture that net revenue more quickly by a slick process than a process which is disjointed. The position of any appointed representatives also needs to be considered. And generally speaking, appointed representative agreements will not automatically transfer to a buyer. Similarly, consultancy agreements are usually personal agreements and are not necessarily freely transferable. There may be a need for separate negotiation around and with key consultants or ARs. I mentioned earn-outs earlier. An earn-out is simply a mechanism for payment of deferred consideration on terms. There is no particular set format for this, but in this industry it's usually keyed into revenue generation. There are many different forms which these clauses can take, but generally speaking, the trick is to strike a balance between the seller's need to be paid properly for the assets it's sold and the buyer's need to protect itself against overpayment, where there are hidden liabilities which come out after completion. The business sale and purchase agreement will generally deal with claims that are made against the business and who bears responsibility for them. And that may be that there are specific items which are essentially the seller's problem and which are agreed to be risks which the seller bears going forward. This usually gives rise to the need to put into place indemnity provisions, which provide that the seller pays for the liability or cost associated with a particular issue, and there may be certain items of other payment which are conditional upon other things happening. So money that may or may not drop in, or money that may be released upon the actual happening of a particular event. Where some form of holding money awaiting that event is needed, an escrow mechanism is very useful. Escrow is simply a mechanism where part of the price is held, usually by the respective parties' solicitors as stakeholders, to await the outcome of a particular event. I've touched upon earnouts above, but there are also usually detailed provisions in the agreement to cater for them. Insurance and run-off cover is another key issue to be considered, and as to who bears the cost of that and what level of insurance is going to be required. That will depend very much on due diligence and the terms of the deal itself. The agreement can often also contain restrictive covenants, where the seller agrees not to compete with the business that has been sold for a particular period of time. These can be fiddly, particularly if the seller is remaining in business in some form after the sale. Where there is an earnout in particular, there may also be a need for clauses around transparency to give the seller appropriate oversight or visibility of the relevant numbers and the reasons why certain revenue may turn out to be reduced or at risk. Finally, from a seller's perspective, issues with payment should be considered. Where there is a significant element of deferred payment, which there normally is in this industry, what security does the seller have that it's going to get paid? Does the seller have a charge over the business? Are certain assets retained and sold out on the drip? Often it's key to bear in mind that taking charges over the assets that have been bought by a buyer can be problematic, particularly where the buying entity has senior bank or other senior facilities in place. Sometimes, not that often these days, but sometimes, one sees buyback clauses whereby the seller can reacquire the assets or a section of them in the event of a problem with payment. But as you can see, all of these items, and several more minor ones, do need to be considered in detail when you're thinking about a transaction of this type. As you can see, this is what we do on a day-to-day basis. We'd be very, very pleased to help, and we'd be very pleased to take any questions. And if anybody does have any questions, if you would like to please either call me or email me, chris.moss@myerson.co.uk, or 07502 348 167, and I'd be very pleased to assist you. Thank you very much for your time this morning, and I hope you found this useful and informative. Thank you.